In this segment, as those know, we go deeper into what is happening in the international markets, how are things changing, where are they changing, and how is that going to drive differentials, the physical market, and then relating back to the futures world. So when we look at, and I always like this new chart that Bloomberg, that BNF does, and it just takes public data and makes it much easier to look at, because when you look at the quota, and this is some of the key pieces, because everyone's like, well, crude should be $150. And then on the people who are looking at the economic side, they're like, well, based on slowing economic growth and recession, it should be, $50. It's like, look, now I'm more on the economic camp where the economic position of the world is slowing. So we should be lower, but they're producing well below quota. So because they're producing well below quota, output quota is 40.1 million barrels a day. They're currently at 38.2. So if we were at 40, we would be at $55, $60, but we're not. And that's keeping us where we are on the future side. That's putting a little bit of that bent into the market. But just consider, there's two sides to the story now, because the question is, and this is on both sides. One, are they below because they can't get to that level because spare reserves are gone? Or is it because floating storage is so high, why would you bother producing at your quota? And there's a mixture of both. And when you look at Nigeria, which made commentary that they want to be back to 2.2 million barrels a day of production, why? Like, who are you going to sell it to? Like, West African floating storage is through the roof. So you're going to produce, you're currently producing at, for December, 1.25, 1.26 million barrels a day. So you're going to double that production. You're going to add 1 million barrels per day to that production level when you can't clear that level. It doesn't make any sense, which is why there's a certain amount of economics mixed in with, and economic decisions, because they want to protect pricing. So if I were to produce quota, prices would at least go down $10 to $15. So why do that? And that's where you get this balancing act, which is they're walking that line. When you look at the backdrop, you can see Saudi fairly stable. Nigeria had a bit of an increase, but you can see things are fairly in line with where they've been previously. And when you look at the different OPEC members in terms of target versus actual production levels, you can kind of see where they sit over that holistic. So the positive number indicates overcutting production. So you can see they're still overcutting production. And a lot of that is driven by Russia and Nigeria and Angola. And obviously Russia has its own issues in terms of piped versus floating versus the export markets. And then again, back to West Africa, where we've talked aggressively about the issues they have. There's no reason for them to produce where they are allotted. So when you look at some Chinese estimates, you can see as we got into January of this year, estimates have increased. OPEC is a bit more cautious on where things are, with the EIA being, I think, as you can see, the most aggressive. I would say that, again, things are going to be a bit underwhelming for China. It'll be better than what it was expected, 2 months ago, 2.5 months ago, when they were in zero COVID, the zero COVID policy. But there's also a knock-on effect, and that's the thing that we keep coming back to. Where, say, China comes back more aggressive, and they buy more crude, but their demand is a bit lackluster. Well, they still have spare export quotas, so that additional product is going to get exported. You're already at record level highs in storage on the gasoline front. Distillate, you're okay with. So this new product is going to put more pressure on refiners in other Asian nations and cause economic run cuts. So as China rebounds, you could get a slowdown in other areas and kind of offset some of those benefits. So then when you look at seaborne crude for Russia, you can see things slow down a bit after that nice little spike. And it's going to be lumpy just because, do you have the boats? Do you have the positioning? Like, are your slips open? There's a lot that's going to come into it, which is going to make it a bit more lumpy as they rely more and more on the seaborne market. So then when you look at where is that crude going, well, some more of it's being labeled unknown, and a lot of that I'm sure have seen the Malaysian chart, where Malaysian exports have increased exponentially. But typically, whenever Russian sanctions, Venezuelan sanctions, Iranian sanctions increase, they tend to become Malaysian barrels. And so it's just funny because people think that they're fooling someone, but again, they're really not. But regardless, a lot of that is heading into the Asian markets. And then when you look at where it's going, India, Turkey, or the unknown, here you can see China has been fairly stable. India started to take more, but more and more of it is becoming unknown. That's just because they could be saying, look, let's just get it into that market because we know there are buyers there. So let's just get it there because there's such a long lead time just based on sailing time to get it into market. Or is it something where they're flowing it into Malaysia and doing additional ship-to-ship transfers? Are they doing more ship-to-ship transfers internally? Those are some key pieces in general. So then when you look at Russian Asian customers, you can see just the level of increase that we've seen on that area, and that's not going to go down. But the more important one is, we're linking them together because Russian Urals ship-to-ship transfers are expected to hit just below 15 million barrels. So here's why. So under the G7 program, ships engaged in ship-to-ship transfers are allowed to use industry standard insurance as long as the cargoes are on board or sold at or below $60. Well, so far they are below $60, so you can still use all of these different methods, especially if you go on a ship-to-ship basis. So ship-to-ship transfers are a routine part of oil trading, and those that are taking place are doing so in full view of satellites. Locations like in Spain or Africa, Greece are being hotspots. So the transfers should also keep ice-strengthened tankers from straying too far from Russia's Baltic Sea. Such vessels are needed in wintry conditions. So again, you're going to see some of the pricing. Most Russian Ural crude has been getting transported thousands of miles to Asia, increasing again. Remember that sailing time, those miles per ton, which is stretching the fleet. So far, a total of 5 VLCCs, very large crude carriers, are likely to be involved in the Urals, the ship-to-ship transfer. 3 completed this and sailed to Asia. 2 more are waiting. 6 more Aframax, which have roughly a third of the transport capacity. So again, you're seeing it transfer to smaller vessels and then move into the market, which is going to help support some of the activity and a little bit of a way to get around those insurance hindrances. And those are the things that we've talked about, because remember, the Russian crude itself isn't sanctioned the same way Iranian crude is sanctioned. So there's an ability to move this about a bit easier than some of the other options. But again, all of this is creating more strife and more struggle for the Middle East, which still it can't clear their floating storage. It is well above the 2022 level. It's obviously 2016, 2017 when there was that massive price war kicked off at the end of at the end of November of 14, carrying through 15, putting a lot of that crude into the floating markets. So here you can see that there's still a lot there, which is going to require another reduction in the OSP or a reduction in production. And there's a way that we could do both, which is why a quota cut is potential. But remember, they're still producing 1.8 million below their quota. So any cut is already kind of factored in. So there's realistically the way to clear this is going to be another OSP cut. By doing that, as we were talking about China and Asia, so if China puts more product into the market, that's going to put pressure on Asian refiners. But if you reduce OSPs, you help the refiners there, because that reduction in cost goes directly to the refiner and could promote additional activity. When we look at U.S. exports, they bounced to 3.73 million barrels a day. Again, that's right in the wheelhouse that we've been talking about at 3.7, 3.8 million barrels a day. European demand is still there. Asian demand has diminished because OSPs on the light end were cut going into Asia, which has been able to undercut some of the value importing from the U.S. when you look at the spread between Dubai and Brent, you can see that it is getting a bit weaker. And that's when you start looking at the reduction in the spread is a good thing for Brent because it makes it, again, more competitive. And that's why some of those discounts are going to have to increase in the Middle East to get some of those crudes out. But the tightening here has actually promoted and helped clear some additional West African crudes, which we're going to talk about in a minute. So when you look at crude oil in the water, bounced up a bit, but you can see it's still seasonally adjusted all-time high. Based on ship-to-ship transfers, based on that activity, we're just going to see more oil on the water regardless because of all of these shifts in the supply chain. Crude oil in transit, again, moving back up because you're starting to get some of those different clearings, some of those different purchases going into the international markets. And it's going to be interesting because as India increases imports of Russian crude, or at least keeps them where they are, which is well above where they normally are, they're going to be making diesel with Russian oil. And then that diesel is going to find its way back into the Atlantic basin. So regardless, the Western world is still going to be buying diesel made from Russian oil. It's just increasing the inherent cost of where it's going and who's buying it. So it's just, something to consider when you're looking at the price of things and why we see diesel prices remaining elevated, because there's more miles per ton, additional costs across not only just the crude, but also on the shipping back to those locations, which is going to keep tanker rates elevated on both sides of that barbell. Crude oil and floating storage. You can see here it's at the highs. It's going to stay at the highs. We don't see that adjusting one way or the other, just given the mixtures back and forth between West Africa, Middle East, Asia, and some of those different pieces. So here you can see Asian floating storage came down a bit, but when we look at new orders and new purchases, we're seeing a fairly sizable increase, as you can see here, which is the only time it was higher was in 2021. So these additional super tanker crude, this isn't so much imports, but just what is coming back into the market. This is accelerating the amount of crude that is going to show up at the Asian coast, which is going to, again, because of some of those back and forth with a lot of product still in storage, a lot of oil in storage, Lunar New Year, these tankers are going to turn into floating storage, which is why we still see Asian floating storage remaining elevated, because this is supporting that thesis. But as we were saying last week, we expect to see a bit more intensity on the Shandong activity level. You can see that it's starting to increase slightly. We see it coming back up to about 65 fairly quickly as we get to the end of Lunar New Year, and likely back to about, let's call it 68, 69 as we come to the end of the holiday and into peak run season. When you look at West Africa floating storage, we had a bit of an increase, and now some things we've seen a bit of an increase of buying, but it's still on the low end. And as you see some increases in production from this region, putting a bit more product on the water, you can see that we're still sitting at some of the highest levels, with the only time higher at this point in time is 2022. So U.S. crude exports and product exports, so finished gas, so motor gasoline, small decline of 41,000 barrels a day, still well above the 5-year. Distillate, big increase of 104,000 barrels a day, well above the 5-year. Then you look at propane, propylene, increase of 280,000 barrels a day, 521,000 above the 5-year. Again, a lot of support going into the international markets. And then we had a big bump of crude exports of 835,000 barrels a day to 4.7 million. Again, some of that is a catch up, because if you remember, not last week, but the week before, we had a number that was way too low. And as we get into the end of the month, beginning of the month, sometimes you get a bit wonky in terms of when the paperwork clears. So again, it's still elevated. We're by no means saying it's not elevated, but it's not, in total 4.7. So when you look at gasoline sticking to the highs, as we were saying, we expected to remain at the very high end of the cloud. We didn't expect it to come this high up. We thought it was going to drop a little bit, but you can see here that it still remains elevated with some of that. But as some of that demand wanes abroad, it should come down a bit. and be a little bit closer to the 5-year average, but that'll take time. So in that regard, we're talking through the end of February. We should see it drift closer to the 5-year average, but again, it's still going to remain above it. Distillate, it's going to stay at the top end of the cloud, and it's just managing flows. There's a lot of demand abroad, not as much demand in the U.S. We're going to continue to see that finding international love. Crude exports, big spike, as we were saying, in terms of timing. Then propane, propylene, you can see here, new seasonally adjusted high. And remember, the last 3 years, each year has continued to see a ratchet up of demand. And it's because the NGL market is heating up. There's a lot of demand. Even as plastics demand falls, you still built petrochemical facilities that need feedstock, and that's going to keep things moving through. As diesel prices remain elevated, you can run propane instead. There's a lot of demand and a lot of tailwinds to support the LPG exports. Now, when we look at what happened to Fujairah, total stockpiles fell just below 20 million to 19.988 with a drop of 168,000 barrels. Light distillate fell 794,000. East of Suez gasoline complex got a bit stronger, tracking a bit of a widening between the U.S. and the RBOB Brent crack on the back of U.S. gasoline demand rise, but we've seen that come back down. And then the expectations of a lower Chinese export in January amid the Lunar New Year shift also was supportive. But unfortunately, at this point, when you look at it, China's Ministry of Transport has forecasted a 99.5% year-on-year increase in passenger trips in 2023. The country's exports are expected to rebound in February after the period, so we should get an increase in inventories as we progress into February. And it'll be interesting to see what the official numbers are, because if you remember back the last couple of years, the forecasted activity and then the actual activity were very big differences, as we've already seen with some of the Chinese data, which we'll talk about on Friday. Middle distillate decreased 21,000 barrels to 2.987. East of Suez gas oil market ended the week on a bit of a stronger note with some supply issues and some Western strength. The arbitrage of gas oil to the west is economically viable, which is why we continue to talk about the flows from east to west on, again, moving things through. So the bullish factor is also the French strike. So the French are striking again for a 48-hour period starting on Thursday. And so a lot of these things are going to continue to maintain some of those flows, which is something that we've continued to talk about. And then the Asian gas oil market has been fairly stable. The question is going to be how much Chinese exports come through and how much of that Russian influence starts to impact as we get the quote-unquote official sanctions starting in 10 days. Heavy resid increased 947,000 barrels there and stood at about 9.912. Spot trading activity at the bunkering hubs were less than average, which, again, we've been talking about. And it's just going to be a balancing act. We do expect to see some builds in light distillate as we normalize a bit going into the end of Lunar New Year. We see the heavy side getting a bit worse, but middle distillate's kind of hovering between that, let's call it 2.8 and 3.1, which is on the bullish end of the storage spectrum. Then when you look at the time spreads in Brent, it's still in contango, and we don't see that changing in the near term, just given where pricing is. So here you can see the shifts. There's been an increase in loadings for Norway following power outages, the increase of Johan. Nigeria slightly below January, but we're seeing some of that creep into Feb. Angola, again, seeing some of those reductions as we've seen some increases out of the Congo. And it's just going to be that balancing piece. So we see things fairly stable. The floating storage in the Middle East and West Africa, again, is showing some slowdown in some of the buying. We don't have any real-time pricing at this point. The only thing that we do have is Vital cut its offer for Fortes on Platts window again. Platts cut this de-escalator for February to 30 cents from 35 cents in January. Vital offered Fortes a dated $1.20 plus dated Brent, but it was $1 and then $1.30 in Feb. which compares with $1.45 and $1.85. So you see some of that walk down that we've talked about, which is just showing a little bit of softness. Nothing crazy right now, but as we get some of these additional builds on West African and the Middle Eastern storage, you could start to see a bit more aggressive moves. West Africa crude exports to Asia are set to increase in Jan to the highest level since September, as small buyers such as South Korea and Taiwan made their first purchases. And a lot of that is driven based on the economics, as we talked about with the cut in OSPs and where U.S. crude is. So as they buy less U.S., they're buying a bit more West Africa, a bit more Middle East. Nigeria increased its official selling price in February for key grades like Q-Ebo and Forcados. But right now, it was increased from 55 in Jan to 95 in Feb, which was the lowest. But remember, 55 was the lowest in a year. So they're just trying to kind of get back to normal. But as we've seen, they start out high at the beginning of the month, and then it slowly gets walked back. And that's what we expect, something similar. OSPs for Forcados were moved from 92 cents to $1.25. But just because they say that, now in Saudi, they give other discounts. They don't ever discount from the OSP, where in West Africa, they do discount off the OSP. So they can say it, but it doesn't mean it'll cross there. And that's, as we've said, they try to start out strong, and then they walk back to kind of find that clearing price. So does $1.25 become 95 cents? There's a very good possibility, given where things are. That's going to be something that we're going to watch as we progress out of January and into February to see how that book is clearing. 47 cargoes of crude are due to load to Asia this month, equating to about 1.4 million barrels a day. Gains from slightly, it was at about 1.3 million barrels a day in December. So again, that slight bump in general, as we got some additional buying from China, India, as well as some of the other ASEAN nations, which is a positive. But as we see West Africa floating storage remaining a bit elevated, there's still going to be some of those pressure points as we see them buying more in the U.S. and Europe buying a bit less. When you look at Europe, builds are fairly stable. As we get some additional pressure on the refining reutilization rates, this will again stay a bit elevated, which is going to cause a bit more discounts on the floating side and in the international market. This is repeated from last week just because we don't have any updated data yet, but you can see that there was a sizable gas oil build. As we saw, we expect to see that increase again when you look at the gas oil side. Gasoline, there's no change based on what we're seeing, so we do expect to see gasoline builds continue and remain at record levels. Same with fuel oil, given the backstop with more Russian product going into Asia. That's going to hurt flows from Europe into other nations, which again is going to result in some additional builds on the fuel oil side. On the Singapore front, we expect to see things that are fairly stable versus historics. Again, this is a repeat, because the new data comes out tomorrow. Because if you remember, we had Martin Luther King, so that's why we did this on Thursday when the data updates, so we have it. Light distillate still is at a record, so gasoline still remains a problem, and we don't see that improving. We see the storage coming down a bit, but still remaining at record levels, with middle distillate still staying in a bullish backdrop. With the same with stuff with heavy resid, heavy disty staying fairly stable and above the average. Now when we look at North Sea floating storage increasing just a bit. We see it still staying elevated, which is why we've seen some cuts to pricing just to clear some of it, and then also supports a bit more flows into Europe, as we have European floating storage kind of flatlining here. And that's just because we saw the pivot from floating storage to land storage. As we get some shutdowns and some strikes, again, it'll reduce a little bit of that demand, which will, again, push some more into floating storage. So we still see that staying a bit elevated versus, or I should say more closer to the average versus where we were last year, which was well below. So that's what we have for you today on the EIA side and in terms of the international side. If you have any questions, please feel free to reach out to us in the comments section on Twitter. And we hope that, as always, you found this helpful. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.